Gold is near a 12-month low, not in Tehran, but 12-month low here of about $12.15, with futures down over $7 an ounce earlier today. To help us out, we are joined once again by Peter Schiff, the CEO of Chief Global Strategist at Euro Pacific Capital. Peter, it's so good to see you again. We haven't had you on for a while, but we appreciate you being with us. Many folks, we've spoke about this before, said that when rates went up, gold would tank, but that didn't happen at the beginning. It didn't happen for a while, but now we see these lower prices. Is that because of the interest rates?
No, I don't think so. I think it's because of the collective delusion among investors around the world that the U.S. economy is actually booming when it's not, and the U.S. is going to win the trade war when it can't. And so I think when reality rears its head, I think gold prices are headed much higher. Right now, they're just around a little bit above 1,200, and I would imagine there'll be some pretty good support around this level.
Well, let me ask you about that. I mean, what are the components that could push gold up? You talk about people really haven't, gotten the full magnitude of what's going on in the economy. We talk about the trade and the tariffs all the time here, not just the rhetoric, but the reality. And that's really hard to quantify to date, but it won't be as time goes forward. And we've spoken in the past, Peter, about the tax cuts and how that might help or may not help the economy. What are the key components that we should be looking at, sort of the metrics that might push gold forward?
Well, I think the economy was a bubble when Trump was elected, and he's managed to blow a little air back into it. It probably would have already been deflating. Your previous guest was going over all of the low unemployment numbers, but they're just as fake now as they were when Trump called out Obama for touting these same statistics. The labor force participation rate has imploded, and so the reason that people are not officially unemployed is because they're not counted, but they are not looking for work, and the stock market is a bigger bubble now than it was when Trump pointed it out as a candidate. So I think as the economy rolls over, because the tax cuts was a bit of an artificial stimulus, but the larger deficits that the tax cuts produce will be a bigger drag on the economy than the temporary boost from the cuts, because it's disingenuous to claim credit for cutting taxes when you simultaneously make government more expensive, which is what Donald Trump did by signing bills to increase military spending and to increase welfare spending. We have a bigger, more expensive government now that taxpayers need to pay for. And if they're not going to pay for it with income taxes, they're going to do it with additional debt, higher inflation, higher consumer prices, and that's what we're seeing. Consumer prices are rising, rates are rising, and those trends are going to continue. And I think as the economy goes back into recession, and as it becomes obvious that we are going to lose the trade war, because we are right now benefiting from the subsidies that foreign economies are extending to us by allowing us to buy what they produce on credit. And when they stop doing that, it's Americans that are going to suffer. And I think the dollar is going to collapse. And, of course, once the dollar starts going down, people will be rushing into gold.
Yeah, that seems to make some sense, and you were so correct. I want to tip my hat to you about the tax cuts. I mean, I thought they were disproportionately spread out, Peter, but you talked about how they weren't going to be much of a stimulus, and I think you just used the phrase artificial there. They have certainly been proven to be used more than anything else for stock buybacks, and that doesn't really go to help move the economy. Anyway, we appreciate you joining us, Peter. We hope you'll come back soon. The CEO and Chief Global Strategist at Euro Pacific Capital, Peter Schiff. Thanks, Peter.